So you don't have to confer, you don't have to wonder, you don't have to estimate, you don't have to investigate. You just look at the damn report. I don't know if any of these regulators can even do that.
All right, let's go. You like that, old man? You want a piece of me?
The entire remaining value of the capital structure of the Swiss National Bank will be lent to Credit Suisse.
I don't want a piece of you. I want the whole thing.
Well, hello there, my friends. Rafi here from the Endgame Investor with this week's silver report for Arcadia Economics. And boy, was it a boring week. Nothing happened at all. Last week's silver report I sent off to Chris on Thursday night, and then I woke up. I got an email from a subscriber telling me about the collapse of Silicon Valley Bank, and then all this stuff started happening, but I had already sent the video off. So, well, is my face red?
Is my face red?
But anyway, we'll catch up this week with everything that's going on, what it means for silver, what it means for the world, what it means for the dollar, all that other stuff. There's some tectonic shit going on. And though not everyone in the gold and silver space will agree, my approach, my belief is that this is the final earthquake before the end game, meaning there will only be one more round of printing and one more rate cutting cycle back to zero, and that will be it for the dollar. Could I be wrong? Of course I could be wrong, but there are reasons that I hold this. It has to do with the shape of a parabola. You've got bailouts at the wazoo, and the bailout that the Fed is giving SVB is applying to all banks that hold treasuries and mortgage-backed securities, which total $4.4 trillion across the banking space. So this bailout could theoretically reach those proportions, and I'll explain why it could. But first, a word from our sponsor, Fortuna Silver Mines. First, the good news with Fortuna Silver Mines, symbol FSM, is that they have finally gotten that permanent injunction against that government agency in Mexico that's trying to shut down one of their main mines. Now they do not have to deal with that again. This has been an ongoing thing for the last year and a half or even longer. Fortuna Silver Mines is pleased to report that the Mexican Federal Administrative Court has granted a permanent injunction to Minera Cuzcatlan, Fortuna's Mexican subsidiary, which allows the San Jose mine to continue to operate under the terms of the 12-year environmental impact authorization. That's it. Problem solved. Let's go to earnings for this last quarter. Fortuna this quarter did suffer an impairment charge of about $160 million due to entrenched inflation problems, which is the same for every miner everywhere. And because Fortuna is not hedged, they have to take the full brunt of this impairment charge. Though adjusting, it says here, for impairment charges and other non-recurring items, adjusted net income was $42.6 million compared to $100 million in 2021. Decrease mainly due to higher costs per ounce across the operations related to a large extent to persistent inflationary trends throughout 2022 and a lower average silver price of $21.8 compared to $25.2 an ounce in 2021. But there is a reason they're not hedged, because this will all reverse itself after the final pivot, which, judging by the tectonic forces moving under the plates of the banking system throughout the world, is about to erupt. And before we get into this week's report, I wanted to make one more case for mining stocks in general and explain what they could do in an endgame scenario by looking at the annual report of one HSBC Bank, which I was researching this week when I was looking at the balance sheets of the major banks to see who would be next to fall. Well, the answer is Credit Suisse, but anyway. I took this from the annual report of HSBC Bank. I noticed this, and at first you'll say, what does this have to do with mining stocks? Well, I'll explain that after I finish reading. So there's a paragraph in the HSBC annual report that says hyperinflationary accounting, defines what that is. Changes to presentation from January 1st, 2022. Application of IAS 29, financial reporting in hyperinflationary economy. So this is what HSBC does, and by extension, any other bank or really any other company, when they are dealing with income from a hyperinflationary economy like Turkey or Argentina. What do they do? How do they account for this? What is the procedure? How do they know how much they're actually making? So here's what it says. Since June 1st, 2022, Turkey has been deemed a hyperinflationary economy for accounting purposes. The results of HSBC's operations with the functional currency of the Turkish lira has been prepared in accordance with IAS 29 financial reporting in hyperinflationary economies as if the economy had always been hyperinflationary. That is the key clause here, as if the economy had always been hyperinflationary. They're skipping down to here. In accordance with IAS 21, the effects of changes in foreign exchange rates, the results have been translated and presented in US dollars at the prevailing rates of exchange on December 31st, 2022. That, my silver friends, is how you account for hyperinflation. Now, what you do is you ignore that it's ever happening and you just count in terms of the prevailing stable currency, which in this case is US dollars, so that your earning statements are stated in terms of US dollars at the closing exchange rate of December 31st of that year, and then you continue on as normal. Now, the question is, what happens when the US dollar itself hyperinflates? How do you do your accounting? When hyperinflationary accounting cannot reference itself to the US dollar at all, then what does it reference to? And the answer, we know, is gold and silver ounces. Now, a gold and silver miner or a mining stock already has its accounting in gold and silver ounces terms. And so if all banks and all companies, all stocks basically, have to switch their accounting to gold and silver ounce terms, who becomes the central bank? The company that produces gold and silver ounces, and they start making loans in gold and silver at interest in gold and silver ounces terms. And there you have an interest rate in real money terms. And this is what gold miners and silver miners are going to become once the dollar hyperinflates, which is getting very close and will probably happen at some point after the final pivot, when the Fed and other central banks cannot do anything but bail out every single systemically important bank on the planet on the same day, which is why they are currently having emergency talks of all central banks in Europe, and probably the Fed is involved. This is what they are probably cooking up now. Okay, we'll start with the small stuff. The small stuff is technical. This is the gold to commodities ratio, and we see that this line over here, this gray line where I put the inspection line on stock charts, this was the 2008 top. You might remember that gold and silver collapsed in the 2008 financial crisis, but in real purchasing power terms, relative to commodities, relative to the GNX Commodities Index, this was the bottom in gold and silver right before the financial crisis, and then the value of the monetary metals skyrocketed throughout the financial crisis because oil was collapsing much faster than gold and silver were, and other commodities were collapsing much faster than gold and silver were. We met a top right over here. In dollars, this was obscured, but if you look at it in commodities terms, this is what was actually happening. Now, we had another spike higher in March of 2020 when gold and silver collapsed again. And then they topped out over here in about April 2020 when oil was about a negative $35 a barrel or something. That this, again, looked like a collapse in gold and silver terms. It was when everyone was selling and silver hit like $11 an ounce or something like that. But it was an all-time high in gold to commodities terms and silver to commodities terms, I believe. And now what is happening is that we have approached and broken through this pivot point that has been established since the end of the 2008 financial crisis in February 2009, and we have broken through it, and I believe we are headed higher from here to a new all-time high. Now, the question is, in dollar terms, what is going to happen in the immediate sense? We have seen relative strength in gold and silver, not even relative strength, but they've gone up since the collapse of SVB, as the safe havens now not only are the US dollar and bonds, but gold and silver as well. Now, to switch over to the other technical issue here, this has been very interesting. This is silver open interest on the COMEX. It's a little bit lower now. I think it's 121,400. This is a day behind, but we see here the jump since the SVB sparked financial crisis. Silver has gone up and the open interest has gone down to about 121,400, which is, again, the low here around that number. It's 120, 121,000. But the point is that open interest is falling while the price is rising. That is a miniature short squeeze. As contracts close out, shorts close out, buy back their shorts, and the price rises. This is not a mega short squeeze, but it means that there is more room to run on the upside here as open interest falls and the price rises. If we zoom out here to a 10-year chart of open interest, we'll see that we are at late 2013 lows So we're about 10-year lows in open interest. This is major potential for silver to climb. And we know the fundamental reasons why, because money substitutes, dollars primarily, are collapsing in all other fiat currencies, and the bailouts are on their way. How extreme are these bailouts? Let's get to the math right now. Okay, so unless you've been living under a rock, which I don't think you have been, we know by now that Credit Suisse is being bailed out by the Swiss National Bank, the central bank of Switzerland, for about 54 billion CHF, or 50 billion CHF, $54 billion, something like that. It's in the 50 billion area, and we're going to get to that number in a second. Now, how bad, this is from an article about the Swiss National Bank from swissinfo.ch, and it says, how bad is the SNB, Swiss National Bank, loss in historical comparison? Well, who is bailing out Credit Suisse, the Swiss National Bank, which has a record, all-time record loss for 2022. It says here, for a long time, the Swiss central bank's profits and losses were in the single-digit billion range. For example, the SNB posted a CHF Swiss franc 8 billion profit in 2007, followed by a 4.7 Swiss franc billion loss the next year. More recently, these figures have fluctuated by a much higher margin. The record 54 billion Swiss franc profit in 2017 stands in stark contrast to the CHF Swiss franc $132 billion loss last year. Look at this. This is who's bailing out the Credit Suisse. This is insane. It gets even worse. Now, Credit Suisse to borrow entire remaining SNB stock equity. I put these two pictures, these two chart table picture, whatever. This is a headline from Reuters, right? And this is the balance sheet of the Swiss National Bank from Yahoo Finance. So on the left, we have Credit Suisse to borrow up to 50 billion Swiss francs from Swiss National Bank. Now, if you look at the Swiss National Bank balance sheet, you see here total equity, and this is in thousands of Swiss franc, total equity, gross minority interest, stockholders' equity, common stock equity, net tangible assets. How much? 55.878 billion Swiss francs. The entire remaining value of the capital structure of the Swiss National Bank will be lent to Credit Suisse. And now you want to get into even bigger bailouts here? Well, we have this chart from the H8 report from the Federal Reserve. Now, what Powell did before we go into this actual table here, I want to clarify what the Silicon Valley Bank bailout actually is. Well, Silicon Valley Bank bailout, they have a bunch of bonds, right? And they're underwater. And they tried to sell them to raise capital, and then the bank collapsed. So what does the Fed do for the rest of the banks that want to stem a depositor flight and a bank run, and they need cash to be able to redeem deposits so that people don't worry and that they keep the deposits where they are? Well, the Fed offers to take the underwater bonds and pay face value for them. So if you have a bond that pays, let's say, $100 in 2 years, but it's worth $70, so the Fed will pay you $100 for it at face value, what it's worth at maturity, and take the loss on their balance sheet instead. So you have money to pay your depositors. So how much of this stuff exists on bank balance sheets, not just Silicon Valley Bank, but all banks in the entire banking system that can now take all these bonds and redeem them for face value at the Fed, to the Fed, and leave the Fed with the unrealized loss on its balance sheet instead of these banks? Why wouldn't they do that? Everyone can do it now. All banks can do this now. Why wouldn't they? They would. And how much is that? We have here from the H8 report, Treasury and agency securities. The total that banks own of this stuff is $4.38 trillion, $2.746 trillion in mortgage-backed securities, $1.634 trillion in non-mortgage-backed securities, which is basically treasuries, $4.38 trillion that they're earning a combined average interest rate of something like 1.65%, some really, really low number. Now, why wouldn't they take all that stuff, sell it to the Fed in exchange for the face value, and then take all that money and slam it into the reverse repo facility at the Fed to earn 4.65% instead of 1.65%. So you're going to have all this money that's now in the banking system in the form of treasuries and mortgage-backed securities being vacuumed out of the money supply of the banking system, put back in the reverse repo facility of the Fed, which pays 4.65% instead of 1.65%. And all that money gets vacuumed out. What do you have? You have collapsing stock prices, a collapsing dollar as the Fed takes on that loss on its balance sheet. and falling asset prices and rising gold and silver as the dollar careens to an abyss. But let's continue. And this just came in, I shit you not. I'm adding this in after I finished the initial recording. This is from Bloomberg. JP Morgan says Fed's loans will provide $2 trillion of liquidity.
Scotty, we need more speed. I'm giving her all she's got, Captain. She can't take any more.
The usage of the Fed's, I'm in the second paragraph, the usage of the Fed's bank term funding program, swapping basically underwater bonds and treasuries and MBS for cash, is likely to be big. Strategist led by Nikolaos Pangurkazoglububi in London wrote in a client note Wednesday, while the largest banks are unlikely to tap the program, the maximum usage envisaged by the facility is close to $2 trillion, which is the par amount of bonds held by U.S. banks outside the 5 biggest, they said. Well, why not them too? Why can't they take their bonds and swap them for cash and put it back in the reverse repo facility and earn that cash as well? Things are just happening too fast. I can't even keep up.
The price is wrong, bitch.
I think you've had enough.
Now, this is not the end of the central bank bailouts. This is just the beginning. Bank of England, it says here in the Telegraph, Bank of England in emergency talks as crisis deepens at Credit Suisse. Now, the second paragraph here is what I want to focus on. Please excuse my chickens in the backyard if you can hear them. They are part of my endgame preparation. It says here in the second paragraph, the Bank of England was holding emergency talks with international counterparts. And who are those? Those are other central banks. There's going to be coordinated central bank action on this. Why? Because we know the Swiss National Bank is lending its remaining worth to Credit Suisse, and they're going to be out of equity. So who needs to bail them out with swap lines? The Fed and other central banks. They're going to do this all together. There's going to be a big announcement. Oh boy. The Bank of England was holding emergency talks anyway with international counterparts on Wednesday night after shares in Credit Suisse plunged as much as 30%, spreading fear through the city of London that overshadowed Jeremy Hunt's maiden budget. Maiden budget. It's a maiden budget, a fair maiden budget. What else is going on? Remember when we saw those articles come out when SVB suddenly collapsed, and then everyone was like, "Oh, how much uninsured stuff is there in the? Nobody knows. It's we have to research it." Blah 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 blah. So all you got to do is look at the annual report of Silicon Valley Bank to find how much of the deposits are uninsured. You just got to look at page 80. It's right here. It says here, uninsured deposits in U.S. offices. Annual report, Silicon Valley Bank, 2022, as of December 31st, 2022. And December 31st, 2021, the amount of estimated uninsured deposits in U.S. offices that exceed the FDIC insurance limit were $151 billion and $166 billion, respectively. So you don't have to confer, you don't have to wonder, you don't have to estimate, you don't have to investigate. You just look at the damn report. I don't know if any of these regulators can even do that. What else do we got? This is the final paragraph of Mermican Research from Daniel Oliver, as you know, my favorite gold and silver analyst, March 15th, 2023, on the collapse of Silicon Valley Bank. The last paragraph. This is what gold and silver stackers need to keep in mind now. I don't think there's any way that gold and silver can fall substantially from here. Maybe for a few days before the Fed and the rest of the central banks bail everything out, but it's not going to be that long now. Powell has lost, he says. Like Arthur Burns in the 1970s, he has discovered that abruptly higher rates threaten stability long before retail prices stop rising. At this point, it is hard to know which is better for gold and silver. More rate hikes that accelerate a major banking crisis, or a pivot to more money printing now. So hang on, guys. The end game knocketh. It approaches. It is coming. There is one more round of printing that we all have to get through. And then the dollar will, in my opinion, though, of course, I reserve the right to be wrong, it will die. That doesn't mean anyone has to do anything rash or zero out cash balances. I'm not saying that. I'm just saying be prepared emotionally, stay calm, stay centered, keep some liquidity in case I'm wrong. But this looks to be the end of the road. The final bailouts are approaching. They are coming. The final printing is coming. And gold and silver are about to overtake the entire pyramid as everything on top of them falls over and through. There will be no time for central bank digital currencies. They will not work. You do not have to worry about them. And as always, this is Rafi of the Endgame Investor. If you enjoyed this Silver Report, consider a 2-week free trial of the Endgame Investor, or become my patron on Patreon, where you will get a weekly biblical commentary on monetary and economic policy topics. And to Chris and Yara, buckle up, stay calm, and hopefully I'll see you this summer.
No? Now you've had enough, bitch.